Now we're going to talk about theta, which is my favorite of the option Greeks. Again, theta stands for time decay. I want to explain a little bit about how time decay works and how in some cases it's in your benefit, in some cases it's to your detriment. So let's walk through the details and then I'll tell you why we do the trades the way we do them. So this is a chart of what I would call time decay. You'll see at the top 120, 90, 60, 30. These are actually days to expiration. So this is the entire range is 120 days. This is the first 30, second 30, third 30, and the final 30 of that 120 day time range. So when you're buying options or selling options, you are buying or selling a time frame. If you're buying a stock, you hold the stock into perpetuity, or you can sell it whenever you want. There's no time associated with that trade. But when you're buying or selling options, there's a time frame attached. Your stock or your option really is not worth anything at the expiration of that. So you need to find a way to execute some specific trade in that time period. Let's discuss how time decay works and how we can use it to our benefit. So time decay is interesting. So this is really the chart that's going to go across, and we're going to see a slope here, and I'll explain what happens during that slope. So this is the rate of decay. So you're probably saying, okay, what exactly am I looking at? What we're seeing here, if we were to buy an option, so if we were to buy a call option in this example, we want the stock price to go up. So what we're going to do if we're ever buying a call option is we're going to buy an option that's going to be between 90 days and 120 days to expiration. The reason is we want some additional time. We want to give the stock time to move in the direction we want it to move. Now it's going to be more expensive because the more you buy, the more you're actually going to pay for it, right? You're buying some additional time. It's going to be more expensive, but it's worth the money. The worst thing you can do is buy really short time frame options, and I'll show you why. So we're going to buy options that are going to be somewhere in the 90 to 120 days to expiration because of time decay. As time goes, let's say we have 120 days to expiration, so it's 4 months out, and we need the stock price. It's a call option, so we need the stock price to increase. As time goes on, we start to lose money. Time decay actually takes money away from what we can capture from that trade. So it's costing us money every day that goes by. So when we're buying options, time is not our friend. We want the stock price to go in our direction as quickly as possible so we don't have to take any losses through this time decay. As you can tell, the slope gets more and more aggressive over time. So between the 120 to 90 day range, it's a very slight slope. 90 to 60 gets even a little bit less. And from the 60 to 30, we're seeing a little more of an aggressive slope, and we're losing more money during that time. And in the last 30 days of an option period, you see a massive decline all the way down to zero. So during that last 30-day period, you lose all of your money if you're not exercising your option. And that would be on a call option or a put option, something that you're actually buying. So when you're buying options, time is absolutely not your friend. So you want to buy yourself some additional time. So if it takes a little bit for the stock to move in the direction you want it to, either up or down, depending on what strategy you're using, you want to buy yourself some additional time, because if it takes a little bit to move, you want to take a minimal loss here. If you buy yourself 60 days or 30 days, every day that goes by, you're going to be losing a ton of money. Now I want to explain how we can use this to our benefit. Once in a while, we're going to buy call or put options. We think there's a good stock move that's going to happen. The price is either going to go up or down, and we can capture some of that. But the majority of our trades are going to fall within that simple 6 range, selling options. And so we'll show you how that you can take advantage of this time decay. So when you're buying options, that time decay happens, boom, you start to lose money. When you're selling options, you're taking the opposite side of the trade. So you're benefited by the time decay. Now, if you'll notice from the other periods of the class, I'm always telling you, hey, we're going to do trades that are roughly 30 days in length. The reason is we don't want to mess around with this really slow time decay where you're just losing a little bit if you bought the option. on the other side of the trade, we'd just be gaining a little bit if we sold the option. We only want to play around in this massive slope. So all the stuff we're going to do, all the trades we're going to make are going to be roughly in this 30-day time frame. And the reason is time decay. Time, when you're selling options, is your friend. Every day that goes by, instead of losing money, if you sold the option, you're gaining money. So every day that goes by, you're starting to gain money. And if the stock price doesn't dip below or above your line, then you get to collect all that premium. It expires worthless. You kept the premium that you got when you initially made the trade. So what really happens here is every day that goes by, a little bit of that premium starts to get allocated into your account until at the expiration date, the very last day of the trade, all of that money has now transferred over into your account. Once the option expires at 0, you get to keep all of those funds. Now let's talk about why we buy or sell. So this is an example of a chart that's clearly in a bullish trend. We could do one of two options. We could either buy a call option, assuming that it's going to continue to go up and make some money there, or we could sell a bull put spread and make money in that manner. So let's talk about the differences between the two and why we generally try to sell options. So let's talk through that. So currently in an uptrend, we believe that the stock is going to continue going higher. Let's, for the first example, talk about buying an option. So if we buy an option, we're buying a call option, we think the stock is going to continue to go higher. We have the stock price currently right here trading at $126. If we think the stock is going to go higher, there is one way for us to make money when you buy an option. If you buy a call option and the stock price for some reason goes sideways, you make no money. You actually lose money through the time decay that happens over time that we just talked about with theta. If the stock price goes down, you lose money. If the stock price works its way up very slowly, but it takes a while for it to move up, the time decay will eat away any of the gains that you would have. So when you're buying options, you have one choice of direction. You really only have one option for that to make you money, and that is it for the stock price to go up. If the stock price doesn't go up and it goes sideways or it goes down or it takes too long to go up, you get eaten up by that time decay and you make no money. So the likelihood of you winning those trades, generally speaking, is about 50-50. And then you're trying to find some key indicators to give you a slight edge. When you're selling options, you have a higher likelihood of winning, and I'll tell you why. As the example before, again, we're trading at a stock price that's $126. That would leave us, the option we would be selling would be a bull put spread, and we'll say this is our spread right here. We're down at say 120 and 115 is the strike below that. So we have a few more options to really make money here. The stock price goes up, we capture all the premium, we win the trade. The stock price goes sideways, slightly up, we win the trade. The stock price goes down, but not too far down, we win the trade. So we really have 3 directions, at least 2.5 directions that the stock can travel and us to still win the trade. As long as by that 30-day period, which would be out here, the stock price is not below our spread, then we're going to make the full premium on the trade. So if it comes down, goes sideways for a little while, then meanders up, then makes its way back down again. Time is our friend when we're selling options. So each day that goes by, we're soaking in some of that premium. So the reason we do credit spreads more than we do just directional strategies like buying a put or buying a call is it gives us a lot more options to actually win the trade. The likelihood is much higher. First off, directional trades are generally buying and selling calls is generally about a 50-50 game. You're trying to get every little piece of information you can to give yourself a slight edge. The directional strategies that we have through credit spreads when we're selling options are actually giving us a likelihood that's more in the 85% range. So the higher likelihood of winning is why we generally choose credit spreads, and those are outlined in the simple 6 strategies. All right, guys, that's it for Simple 6. Let's walk through those trading strategies one more time, just so you understand how they work together. Naked call and a naked put. A naked call is when you want the stock price to be below your line. A naked put is when you want it to be above your line. If you add those two trades together, that's what creates a short single. That's the first 3 of Simple 6. The second 3 is a bear call, which is the credit spread that you want it to stay below your line. The bull put is the credit spread where you want it to stay above your line. Put those two together, that creates an iron condor, which is the neutral strategy where you want it to stay in the middle. And that is the second 3 of Simple 6.